Welcome, ladies and gentlemen, to Boss Economics World, the only show where we take the dismal science of economics, sprinkle it with a healthy dose of satire, and serve it up hotter than a Wall Street trader's temper during a market crash. I'm your host, the one, the only, Professor Profit, here to break down the economic chaos, call out the absurdity, and maybe, just maybe, help you make sense of this mad, tariff-tastic world. Buckle up, folks, because today, we're diving headfirst into the latest chapter of Donald Trump's great tariff tantrum of 2025. Spoiler alert, it's a global economic dumpster fire, and we've got the receipts to prove it. Now, if you've been paying attention to the headlines, or, let's be real, doom-scrolling X like the rest of us, you'll know that as of July 29, 2025, the world economy is teetering on the edge of a protectionist precipice, courtesy of America's favorite dealmaker-in-chief, Donald J. Trump. With his latest tariff deadline looming on August 1, 2025, the man who once called himself Tariff Man is back at it, slapping higher duties on anyone who hasn't signed one of his Art of the Deal trade agreements. The EU, Japan, and a handful of others have caved, agreeing to preliminary deals that jack up tariff rates, but for the rest of the world? Well, let's just say Trump's got a bigger tariff hammer ready to swing, and the global economy is the nail. But hey, at least the stock market's doing great, right? Right? Oh, sure, financial markets seem to have decided they can live with it, rebounding from the brief slump triggered by Trump's so-called Liberation Day tariff rollout back in April 2025. But let's not kid ourselves, folks, this is like putting a band-aid on a broken leg and calling it a cure. The real damage is happening beneath the surface, and it's reshaping the global economy in ways that would make even the most stoic central banker break out in a cold sweat. So, grab your calculators, your coffee, and maybe a stiff drink, because today, we're going point by point, surface to core, to unpack the economic insanity of Trump's tariff tirade. And trust me, it's juicier than a steak at Mar-a-Lago. Let's start with the big picture, shall we? According to the brainiacs at Bloomberg Economics, Trump's tariff tantrum is set to shave a whopping $2 trillion off the global economy by the end of 2027, compared to its pre-trade war path. $2 trillion. That's enough to buy every single person on Earth a fancy new iPhone 17 Pro Max, and still have change left over to fund a moon base. But instead of innovation or growth, we're flushing that cash down the protectionist toilet, all because Tariff Man wants to make America great again. Spoiler alert, it's not working. Now, you might be thinking, Professor Profit, isn't some of that damage going to be recouped as supply chains realign? Sure, in the long run, some production might shift, and new trade patterns might emerge. But here's the kicker, realigning global supply chains isn't like rearranging your Netflix queue. It takes years to build factories, train workers, and establish new trade routes. And in the meantime, companies are freezing capital spending, rerouting supply chains, and trimming margins faster than a barber giving a buzz cut. Just ask Nature Sweet Tomatoes, the largest greenhouse tomato producer in North America. They wanted to double their capacity in Arizona, but thanks to Trump's tariffs on Mexican tomatoes, Sri Lankan coconut husks, and Chilean fertilizer, their expansion plans are on ice. And get this, their Canadian competitors? Zero tariffs. Nada. Zilch. Talk about a raw deal. And it's not just tomatoes, folks. Japanese auto firms, US tomato growers, Vietnamese sportswear plants, they're all getting clobbered by Trump's America First doctrine. Early winners. Sure, a few US steel producers are popping champagne, but the inadvertent casualties are piling up faster than unsold rose in a French wine cellar. Speaking of which, let's pour one out for Cave Heracles, France's biggest organic wine cooperative, which is sitting on 2.7 million bottles of unsold wine, 500,000 liters of it rose, because Trump's tariffs have slammed the door on their biggest export market, the US. Cheers to that, right? Now, let's zoom in a bit and talk about what tariffs actually are, because apparently, some folks in Washington need a refresher. Tariffs are taxes. Period. And guess who pays them? Not China, not the EU, not Japan, nope, it's American importers, who then pass those costs on to, drumroll, please. You, the American consumer. That's right, folks, Trump's tariffs are essentially a tax hike on everything from cars to tomatoes to wine, and it's hitting your wallet harder than a Black Friday sale at Best Buy. According to Bloomberg Economics, the average US tariff rate is now just under 13.5%, up from a measly 2.5% last year. And if the EU deal goes through, that'll jump to 16%. To put that in perspective, the overall US tariff level is now the highest since the 1930s, yes, the decade of the Great Depression, when protectionism turned a bad recession into a global economic catastrophe. Coincidence? I think not. And here's the kicker, Trump loves to brag about the windfall of Treasury revenue from these tariffs, but he conveniently forgets to mention that it's American businesses and consumers footing the bill. Because of tariffs, our economy is booming. He tweeted in June 2025. Booming, he says. Meanwhile, companies like General Motors, Dow Incorporated, and Tesla are reporting earnings hits, and consumer spending, the engine of the US economy, is flatlining faster than a bad sitcom on network TV. And let's not forget the ripple effects. According to ING's chief international economist James Knightley, U.S. consumer spending in 2025 has noticeably flatlined after strong post-pandemic gains, with households worried about tariff-induced price hikes and a cooling job market. The latest GDP data, due out on July 30, 2025, is expected to show a bounce back in headline growth for Q2, but don't be fooled, that's just because companies front-loaded imports in Q1 to beat the tariffs, which artificially shrank the economy, and now imports are retreating. If you dig into the real numbers, like inflation-adjusted final sales to domestic purchasers, growth slowed to 1.9% in Q1 2025, down from 2.9% in Q4 2024. And the Atlanta Fed's GDP Now forecast predicts it'll slow further to just 1% in Q2. Booming, huh? More like sputtering. Now, let's get to the juicy stuff, the stuff that keeps CEOs awake at night and economists like me reaching for the antacids. Trump's tariffs aren't just a tax on trade, they're a tax on certainty. And in the world of business, uncertainty is the silent killer of growth. Just ask Stanford's Nicholas Bloom, who's documented how companies hold off on big capital bets in uncertain times. And boy, oh boy, has Trump delivered uncertainty in spades. Take foreign direct investment, FDI, for example, those long-term bets on factories and projects that are key to economic growth. According to the United Nations World Investment Report, global FDI is headed for another decline in 2025, after an 11% drop in 2024. Why? Because tariffs have turned the global economy into a game of whack-a-mole, with companies scrambling to figure out where to invest, where to produce, and how to avoid getting clobbered by the next tariff hammer. In every G7 country, forecasts for business investment in 2026 are lower now than when Trump took office in 2025. Lower. So much for that CapEx comeback Treasury Secretary Scott Bessent keeps crowing about. Sure, there was a brief surge in equipment imports in early 2025 to beat the tariffs, but since April, investment has stalled out, with non-residential investment contributing just 0.1% to GDP growth in Q2, according to the Atlanta Federal. That's not a comeback, that's a coma. And it's not just the US. In Japan, the recent tariff deal limits the GDP hit to 0.55%, according to Nomura Research Institute's Takahide Kiyuchi, but that's still larger than Japan's average annual growth rate. Japanese carmakers, who rely on the US as their biggest market, are slashing export prices to stay competitive, with car shipment values down 27% in June 2025, even as unit volumes rose. In Europe, Volkswagen AG just cut its 2025 earnings guidance, citing billions in tariff-related costs. And in Vietnam, manufacturers are in a holding pattern, unsure whether to ramp up production or lay off workers, thanks to Trump's flip-flopping on tariff rates, 46% in April, 20% in June, and maybe double that for goods routed through Vietnam from China. Talk about a roller coaster. Now, let's zoom out again and look at the global domino effect, because Trump's tariffs aren't just America's problem, they're everyone's problem. China, the biggest US adversary, is already struggling with slowing growth and deflation, and tariffs are making it worse. Bloomberg Economics found that only 2.4% of China's GDP, 5 out of 33 industrial sectors, can absorb the current tariffs and remain profitable. So, what happens to all those Chinese goods that can't be sold to the US? They get dumped elsewhere, flooding emerging markets with cheap products, pushing down prices, and threatening local producers. It's like a global game of hot potato, except the potato is a shipping container full of unsold sneakers. Meanwhile, countries like India are trying to capitalize on the chaos, touting low wages and a young workforce to attract manufacturers. Commerce Minister Piyush Goyal is optimistic about negotiating a lower tariff rate than the 26% currently slated for August 1, 2025, and companies like Delta Electronics India are seeing a surge in inquiries. But let's be real, India's infrastructure and regulatory hurdles make it a tough sell compared to, say, Vietnam, which was a big winner during Trump's first-term trade war with China, but is now getting whiplashed by its own tariff drama. And then there's Brazil, where Trump is threatening a 50% tariff over a political spat that has nothing to do with trade. Engine maker WEGSA says its clients are delaying investments, and the company is scrambling to reroute exports through India to avoid the tariff hit. Months of adjustments, millions in costs, and for what? To dodge a policy that could change on a whim, depending on Trump's mood or the latest Fox News segment. So, what's the big takeaway here, folks? From the surface-level chaos of supply chain disruptions to the core economic issue, it all boils down to one simple truth: protectionism doesn't work. It didn't work in the 1930s, when the Smoot-Hawley Tariff Act turned a recession into a depression, and it's not working now. Tariffs are a blunt weapon, creating a few winners but far more losers, and the collateral damage is staggering. They're a tax on consumers, a drag on growth, and a recipe for global economic uncertainty. And the worst part? Trump's not even achieving his stated goal of bringing factories back to the US. Sure, there's talk of a $550 billion investment fund with Japan, but that's just an idea, not a reality. Meanwhile, the real investment, global FDI, is tanking, and companies are too scared to make big bets. So, to my audience of everyday folks worried about your financial future, and to the finance pros watching from your corner offices, here's my advice: brace yourselves. The tariff tantrum isn't over, and the economic fallout is just beginning. And to Tariff Man himself? Maybe it's time to crack open an economics textbook, or at least watch an episode of Boss Economics World. Because if there's one thing we've learned, it's that the art of the deal doesn't mean a thing if the deal screws over the entire planet. That's all for today, folks. Don't forget to like, subscribe, and ring that bell for more economic satire and hard-hitting analysis. Until next time, this is Professor Profit, signing off, because in this economy, someone's gotta keep it real.